Hey everyone, and welcome back to The Explainer. So today we are going on a bit of a hunt. Think of this as a financial detective story. We're going to uncover the true hidden value of a company using what is arguably one of investing's most powerful, but honestly most misunderstood tools. Imagine someone pulling you aside and whispering, "Hey, this company is literally selling for less than it's actually worth." I mean, it sounds like an impossible bargain, right? But believe it or not, this actually happens in the market. Today, we're going to learn exactly how to spot these hidden gems, and maybe even more importantly, how to avoid the traps.
And hey, don't worry if financial jargon usually makes your eyes glaze over. Here is our quick roadmap for today. We'll start with the impossible market bargain, then we'll unpack book value, decode the different PB scenarios, look at exactly when to use this tool, when it totally misleads us, and finally, we'll put it all into practice. Let's jump in.
All right, part one, the impossible market bargain.
So this is the whole premise that kicks off our investigation. Sometimes the stock market does something that just seems bizarre. It values a company at less than the total value of everything that company owns, even after you subtract all its debts. To really wrap our heads around this, let me ask you a question. If I offered to sell you a gorgeous house that was definitively, officially appraised at 10 million Kenyan shillings, but I was only asking you to pay 7 million, would you buy it? I'm guessing your gut reaction is a massive yes, right? It's a huge discount. It sounds like the deal of a lifetime. But before you sign those papers, you gotta know there's a catch.
Here's the twist. What if that heavily discounted house had hidden structural problems? We're talking a sinking foundation or a massive termite infestation. Well, suddenly, that 7 million shilling price tag doesn't look like a bargain at all, does it? It looks like a giant liability. I want you to keep this detective framework in your mind as we go forward. Just like real estate, a stock might look like this incredible cheap bargain on the surface, but the market might actually be frantically waving a red flag, trying to warn you about hidden dangers. We need a tool to investigate this.
Which brings us to part two, unpacking book value. Let's cut right through the jargon.
Before we can even begin to figure out if a stock's price is fair, we absolutely have to know what the underlying business is fundamentally worth. And the crucial starting point is book value. You might also hear it called shareholders' equity. It is simply the value of everything a company owns after subtracting all of its debts. That's it. It's the true bedrock net worth of the business. Think of it this way. If a company sold off every single thing it owned tomorrow and paid off every single penny it owed, this is the pile of cash that would be left over for the owners, the shareholders.
Let's keep the math super simple here. Imagine you own a transport company. You tally up your total assets. Say you've got 10 buses, the land they park on, your spare parts, and whatever cash is sitting in the bank. All of that adds up to 100 million shillings. But you also have liabilities. You owe 40 million shillings in bank loans and supplier bills, so we take our 100 million in assets, subtract the 40 million in liabilities, and boom, we get a book value of 60 million shillings. Now, if your company has 10 million shares out there in the world, we just divide that 60 million by 10 million. That gives us a book value per share of exactly 6 shillings. Pretty straightforward, right?
And that little calculation builds right into our ultimate detective tool, the price-to-book ratio, or PB ratio. The formula is literally just the share price divided by the book value per share. So sticking with our transport company, if the stock market has priced your shares at 12 shillings on the exchange, and we just figured out our book value per share is 6 shillings, we divide 12 by 6. That gives us a PB ratio of 2.0. But what does that number actually mean for us? It means the stock market is currently willing to pay 2 shillings for every 1 shilling of actual physical net assets the company holds.
Let's move to part 3, decoding the P/B scenarios. Time to look at some market clues.
Now that we've got our main tool, we're going to investigate 3 distinct crime scenes, so to speak, to see what the market is trying to tell us. Scenario 1 is definitely the most intriguing. What happens when the price-to-book ratio is less than 1? Imagine a company where the book value is 20 shillings per share, but you can buy the stock for only 15 shillings. That's a PB of 0.75. Stop and ask yourself, why on earth would investors only pay 15 shillings for assets that are mathematically worth 20? Well, look at the clues. The market might be predicting weak future profits. Maybe the company has notoriously poor management. Perhaps there are looming regulatory risks. The whole industry's going downhill. Or maybe there's just sheer market panic. A ratio under 1 could be a brilliant, hidden opportunity if the market is just overreacting. But it could also be a dangerous value trap if the business actually has those hidden structural problems we talked about earlier.
Then you have scenario 2, where the PB ratio equals exactly 1. So the share price is 25 shillings and the book value is 25 shillings. This is basically neutral ground.
The main clue here is that the market price perfectly mirrors the accounting net assets. Investors basically believe the company is worth exactly the sum of its physical parts. Nothing more, nothing less.
But then we get to scenario 3, where the PB ratio is really elevated, let's say above 3. If a company's book value is 20 shillings, but the stock is trading at 80 shillings, the PB is 4.0. Why in the world would someone gladly pay 4 times the actual book value of a business? It all comes down to things like a dominant, super strong brand, exceptionally high profitability, or a really high return on equity. Add in excellent management and high expectations for future growth, and it actually makes total sense. Sky-high ratios often point to massive value in things we just can't physically touch.
Okay, part 4, when to use it. Let's talk about where this metric shines.
Like any good detective tool, the PB ratio isn't a magic wand for every single case, but it is incredibly useful for specific types of businesses. It works absolutely best for banks, like Equity Group in Kenya or JP Morgan Chase in the US. It's also fantastic for insurance companies, think Jubilee Holdings or Berkshire Hathaway. It's great for investment holdings, like Centum or BlackRock, and real estate firms like Stanlib, iREIT, or Realty Income. Why these guys? Because these businesses have massive, easily measurable physical asset bases. Their loans, their properties, their cash reserves, it all makes their book value a highly reliable metric for you to anchor your analysis on.
Now for part 5, when the ratio misleads. Welcome to the danger zone.
You absolutely have to know your tool's limitations. While it is perfect for traditional brick-and-mortar companies, the PB ratio is deeply misleading for companies whose value comes from intangible assets. I'm talking about tech and intellectual property giants, Microsoft, Apple, NVIDIA. The true value of a tech company lies in its proprietary software code, its global brand loyalty, and its network effects, right? These incredibly valuable things rarely show up fully on a traditional balance sheet. So if you try to evaluate a modern tech giant using only its price-to-book ratio, it's always going to look wildly overpriced, and you'll end up completely missing out on the actual value of the business.
Finally, part 6, putting it into practice. Let's do a real-world exercise.
We've covered the theory, so now it's time to get your hands dirty out in the field. I want you to actually set up a comparison table. Go gather some data on Kenyan companies listed on the NSE, maybe KCB Group or Absa Bank, and compare them right alongside US companies like Citigroup or Progressive Insurance. Fill out the share price and the book value per share and do the math to calculate that PB ratio. Then, just look at them side by side. Which company has the highest ratio? Which has the lowest? And crucially, putting your financial detective hat on, ask yourself, why? Is the bank with the lowest ratio an incredible bargain, or are they secretly sitting on a pile of bad loans? Is the high ratio company actually worth that massive premium?
Because to summarize our whole lesson today, please remember this one thing. A low PB ratio does not automatically mean a stock is cheap, and a high PB does not automatically mean it's expensive. The ratio is literally just the starting point of your research. It's not the final answer. Great investors don't just blindly buy low ratios. They pause and ask, why is the market pricing this company this way? Is the book value actually high quality? That shift in thinking is how you stop just chasing stock prices and start actually understanding businesses.
So as we wrap up this explainer, here is your homework. Download the data, calculate these metrics for one Kenyan company and one US company, and then answer this perspective-shifting question for yourself. Would I want to own this entire business for the next 10 years? Why or why not? Keep digging, keep asking those tough questions, and I will see you in the next one.